Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Trump's full court press on Fed Chair Jerome Powell and what might move mortgage rates this summer. Logan, welcome back to the podcast.
Welcome back to the award-winning podcast. That's how we should start it off from now on.
That's what we're going to say every single time. I love it. That was great. Okay, we had quite a bit happen on Juneteenth. So we're recording this on Friday. So on Thursday, we had all sorts of things. And really, it comes down to, can President Trump convince Powell to lower rates, right? And you wrote two stories for us on Thursday. Talk about what those stories were on.
So number one, Trump talked about cutting rates 2.5%. And immediately I just thought that's more of a budget thing. Many months ago, we talked about, if Trump takes like a different angle toward, than his first presidency, where he waited to get some stuff done, got the tax cut done, got all this stuff done before he went into, trade war tap dance. Here, because he's got to do a budget, he's got a tax cut. And, I was pondering, like, how are they going to handle the interest payments going out for 10 years? Because, Trump would probably want lower rates just to add more tax cuts into the plan. What we're dealing with now is that, it's a little bit harder to pass the budget and the tax cut now than before. And one of the things is Trump wants lower Fed funds rate just to give him more wiggle room for the deficit. And this is something that the Federal Reserve does not care at all about that. That's not part of their dual mandate. And in the article I wrote, that Trump really, if he really wanted to talk Powell down, and obviously Powell's not going to listen to him, but if you wanted to play the ref or be the high school basketball coach, hence, wink, wink, you want to talk the ref down for another call later in the game. And the labor market is a better way to do it. I know a lot of like conservative media types, or like late last year, early, were talking about, we have to create a recession because we have to refinance the debt and all this stuff. And that the Fed has to cut rates. A lot of people for years have said the Fed has to cut rates because of interest. No, they don't. And they haven't. And that's never been a thing. That's not. And oddly enough, Fed President Waller this morning says, our job is employment and inflation. We don't cut rates to give cheap financing for the federal government. So that article was more or less, there are things about the labor market you can talk about and highlight, and things that Powell left himself open to for criticism. But cutting the Fed funds rate to make the budget work is just, that's not a thing. That's never going to be a thing. And it probably doesn't resonate to people as much as more as the labor market or the economy.
I thought that was a great point that you made, was like, listen, if you want to make this, one of the things that Powell said that we talked about right afterwards was like, he was like, yeah, it's really hard for people to find a job right now. It's like, okay, well, that should be an indication that labor is weakening, right? If it's so hard to find a job. And he said that himself. So that would be something to talk about.
Well, I mean, I would frame it as, what is neutral policy for the Fed? And the reason I say labor over inflation is that before any of the tariffs happened, they were talking about neutral policy is almost here. Maybe we're here. They were saying stuff like that, which means they were not in rate cutting mode until they see the labor market break. So I think there is a more clever way to kind of go after Powell if you're looking for Fed rate cuts, than to say, cut 2.5% interest payments, let me get my tax, that's just not something they look at. And I've been talking about this for some time, that people just assume that the Fed has to cut rates because of the interest expense. No, that's not even part of their mandate. So that's a whole different subject, a different part of government out there. So hopefully now people could understand why that was, something that I've talked about. But for Fed President Waller to basically make that a statement, he's very open to rate cuts happening, but not because, we want interest expense to go down.
So I think that's the other thing, is like, it's not just what the internal, what our national audience thinks, it's what international does, right? I mean, this is our central bank. We need to, it needs to act in a way that continues to inspire confidence, right, throughout the world. And so you could make this move, but you have to be careful about how you present this.
Well, I just don't think the Fed's ever going to like go that route. So that's just, I mean, literally, they would like lose all credibility if they did anything like that. Well, we have to make the interest payments work for the budget for the tax. No, so it's not even it's not a talking point. And just mind, we are the most powerful economy in the world. We run the show. So all the other banks, Federal Reserves, are just little tiny little puppy dogs compared to us. So in this regard, the Fed has very kept it clear, at least for me, since 2022. It's about the labor market. And until the labor market shows some deterioration, the Fed isn't going to do anything. They played catch up last year because the labor market was softer. You have to remember that the Fed hid behind the 2024 labor market as saying, remember 2024, they said, we need confidence. We need confidence. We need confidence. We need confidence. No, you don't. You just didn't have, you need a labor market. So all of a sudden they're like, oh my God, the revisions are really bad. Oh, whoa. Wait a second. So, and then the job data stopped getting as weaker as it did the pace of it. And now hold it. We're going to hold it. No rate cuts. Tariffs. Let's hide behind that. Yeah. Tariffs. We're going to wait on that one. So they're doing what was perfectly normal to me. But again, the net interest thing is just a waste of time. That's just not going to be a valid thing the Fed even works off of. And for people to say that we were going to purposely go into a recession to refinance, no. Thankfully, I think I haven't seen that gimmick. By the way, conservatives are very good when they do this summer camp media blitz and everybody gets the same thing. The only problem is everybody says the same sentence. You're all going to do this. Tell people to talk differently. You could just tell that this was like a code, like all these other TikTok and Instagram, all these sites are all saying the same thing. So be a little bit more clever out there. It's like the one guy that trolls you, creates 27 different fake accounts, but he writes the same way, it's him. They're just like, come on, show a little effort. But that was not a thing. Labor market, you can go after. The economy, trying to get ahead of it, that's perfectly fine, perfectly normal. But the net interest payments,
Okay, so the potential shadow Fed president, interesting. We had the FHFA Director Bill Pulte call on Powell on Thursday to resign. Obviously, the FHFA director doesn't get to tell the Fed chair to resign, but he can say that. But it does bring up the fact that what you've said is that shadow Fed presidency just becomes more and more of an option as we go, seemingly. So do you feel like Waller is now in first place there?
No, I actually don't think Waller is in first place. I would rather have Fed President Waller be nominated or Michelle Bowman. I do not want Kevin Warsh to be the next Fed chair because Kevin Warsh almost looks like a puppet now, and I don't know if he did a deal with Trump. Hey, name me the Fed president. I'll cut rates right away and I'll do the shadow Fed thing if you want. Yeah. But I just think if you have an institution, it's really hard to have a guy come out who's just basically been bashing, has done a little tour about bashing the Fed for like 2 years. And that, I want to be the president of this. And it rubs a lot of people the wrong way. Even if people who agree with him, just like, there's just something about that. It's like a rat, out there. So it's just not. I would rather have Waller or Bowman be nominated, and you have some Fed credit. Now, of course, that's not the shadow Fed president that Bessent and them were talking about. That's the thing, that if you're going to a shadow Fed president, you're talking to the person and say, hey, listen, I get you in, you do this for me, right? You go on TV and you tell everybody you're going to cut rates, bond traders, get your head out of what, and forward guidance is coming down here. That was the whole concept of the shadow Fed. It wasn't like, a lot of people don't understand the shadow. It sounds like very sinister, but it's just telling the marketplace, this is our guy, and the guy just basically telling the market, hey, listen, rates are going down, but Bowman and Waller at least are, are in the system, and they would be respected. And I'm not saying that both of those two just turn from being inflation hawks to labor over inflation, but they both can actually coherently give a better example of why like Waller does a good job of explaining why he doesn't want to wait for the labor market to break before cutting. He could say, "We'll cut rates if inflation takes off again. We'll hike it, but let's be a little bit more careful." That's a little bit more coherent than saying, "Hey, Warsh, you work for me, you do this stuff, I'll get you in." Because then when Trump leaves, that guy's still there, and then you just don't know what you have with that. So I would be much happier if Waller or Bowman, two conservatives that conservatives do like in the House and Senate, them to be nominated and then go there. But again, that somewhat defeats the shadow Fed president purpose. So obviously here, what I'd want to see probably is not going to be the case. But again, it's something we all think about. I mean, it isn't shocking to me that both Trump and Pulte went after Powell after the Fed meeting. But we're just, again, it's going to be a very, very interesting second half of 2025 with this backdrop in place, especially if the labor market, if the labor data starts to get weaker and weaker. There's a series of economic data lines tied to the labor market that shows the softening. But again, my premise is they need something breaking, right? The only reason they started cutting last year is like, oh boy, those revisions are negative. We better get with it. Now it's the argument for me is, what is neutral policy? Because don't you want to be in a neutral policy stance if something bad happens, rather than be modestly restrictive? So there are ways to go after Powell and the Fed and make it a little bit more coherent, I think. But I just believe Waller and Bowman are a little bit better suited for that chairman role.
Interesting. So interesting. Okay, so you're sitting out there, you are a mortgage loan officer, you're in real estate, you're in part of this industry. Do you have hope for between here and the end of the summer that we're going to see a pickup in sales for different reasons?
Well, number one, we're going to have year-over-year growth in sales. It isn't going to be a problem just because last year's comps are going to be very low. So I'm prepping people for in July to November, for the months of June and October, we're going to have year-over-year growth. That's assuming even if sales just stay flat. If you get any kind of better, like purchase application data has shown double-digit year-over-year growth the last 7 weeks. So the year-over-year, you get more mortgage buyers. Now, if cash buyers are falling at a on pace or faster rate, they can offset each other only to a degree, because the majority of all buyers are mortgage buyers. But again, the only 2 times that mortgage rates headed down towards 6%, the economy was really showing weaker data out here. Mortgage rates have been very calm. I mean, just very calm lately. We've had a lot of data, Fed, all this drama. We don't see the wild movements anymore. The spreads have gotten better. They've limited the damage to the upside, and the 10-year yield is not falling because it doesn't whiff a recession yet. So not like what happened with Godzilla tariffs. So the market is calm. I think this is a better place to work off of without the crazy volatility. But if you're looking for lower rates, it's the same thing we've always said. This is why we do channel forecasting. You're going to need weaker data, weaker labor data. And the labor data, again, for me, for the first time in many years, is underperforming. So we don't have a lot of wiggle room anymore. And that's part of the, those articles I wrote about Trump and Pulte, there's not a lot of wiggle room. You could go for something like that to get yourself to neutral, but that's all you're going to get to is neutral. Maybe neutral is 3.5%, find a way to get there, but no tariffs. If there were no tariffs, we're only going to get 2 rate cuts this year. They're still talking about 2 rate cuts. Nothing has materially changed except the Fed has raised its inflation expectations. And now there's almost a civil war in between the Fed presidents, those who want to get that 2 rate cuts and those who don't want to do that. So we'll take it from there. But there's a lot of moving parts in the second half of 2025 that can create some volatility in the economy and in rates. So we'll see that. This is not even counting what President Trump does with the shadow Fed president, I think, if he goes that route. But you could clearly see the frustration by the White House and the economic team on the lack of forward guidance, I think, on Powell's part.
So last year in August is when we saw rates dip a little bit, right? End of August, September, ahead of the September rate cut that ended up not being a cut for mortgage rates. They actually went up because they'd already come down. So how do you explain something like that? Like, do you think something like that could happen again?
You and I had this discussion. I remember last year where I said, "Man, mortgage rates are well ahead of the Fed." Right? It's just
Right.
like the Hodor line. That's why we created the Hodor line. For those I know, nobody likes me saying
Hodor.
it. Hodor, whatever. Okay, so we create kind of choke points to where we don't think the 10-year yield can go lower. In 2023, it was the Gandalf line around 330. It said, "You breaking this, you're basically saying recession." Okay, it held 8 times. In 2024. Hodor line was created around 380. So I think it was December 28th in 2023 that line was first checked. It didn't break. But what happened in 2024 is authentically the bond market was really forecasting like the labor data to really start breaking. So we had a 2% move lower in mortgage rates with no rate cuts. And that's why you and I, when we had that podcast, I said, "No, my God, this has to be it." Because we're well ahead of what Fed policy is. So the Hodor line has it now. We broke that line, and then all of a sudden we got the rate cut, and then the economic data started getting better, and the 10-year yield went up. Yep. So where we are right now, between 435, 470 on the 10-year yield, per the forecast, looks good. Looks normal to me, unless the Fed wants a guide more dovish or the labor data gets weaker. We won't see a similar type of move from last year just because the volatility isn't there. We saw something like that already early in the year when the market saw Godzilla tariffs and everyone went into recession mode. Oh God, the 10-year yield got below 4%. And even myself was like, we don't belong here. We're not there yet. Fed policy isn't there yet. The market got ahead of itself. So to answer your question, we already had that this year, April 4th, 2025, I remember because it was Jobs Friday and the 10-year yield is a 4%. And I tweeted out, we should not be here. The labor data is not breaking enough for the Fed to we're getting ahead of the curve. And then 10-year yield shot right back up. I think today we're at 439 right now. So we already had that wild move. Now, if we have a series of really bad data lines, jobless claims prints 289,000. We have one jobs report at 60. You can get that kind of traction, but that's the only thing that really creates that volatility. It created in 2023, it created in 2024, and created in 2025. The perceived notion of the economy getting weaker and the labor data breaking has been the reason why the 10-year yield has made those big moves lower, headed towards 6%. This year, the move was so fast that rates didn't even have a time to catch up. I think we got 650 was like the low, 655. Different kind of setup, but it is something to keep an eye on for the next 6.5 months. If the data gets weaker, what happens with a trade war? What deals are made? What happens with the shadow Fed? We have tons of stuff packed in for the second half of 2025, where the first half was Godzilla tariffs. Godzilla tariffs came, all hell broke loose, right? So we don't have that kind of backdrop unless something else happens. We take baby Godzilla off and keep Godzilla tariffs on. So we'll see. But again, all that for the second half of 2025 is in play.
Listen, we cannot count out that something big is going to happen that we can't even see right now. These things happen. I think one of the surprises to me when we look back at, I remember we had a special issue, a special podcast when Russia declared war on Ukraine and what that did to mortgage spreads and just kind of that uncertainty in the market. We haven't really seen that, even though there was talk about the United States joining in the war against Iran. And I don't know if that's because, Trump pulled back and said, hey, I'll decide in 2 weeks if we're doing that. But have you seen anything happen?
So what happens in the Middle East is very short-term oriented. So it wouldn't have that kind of impacts because we've been here before, and traders are like, okay, we've seen this. This is not going to be anything. What it's done is the volatility is in oil prices. I'm such a nerd. I sit there and I show oil prices on my Instagram stories. I go, look what happens when the headline happens, But in this case, Godzilla tariffs were recessionary. Like if Godzilla tariffs stayed, everyone was in 100% of the recession camp. People were just like the stock market, every conservative bullish economists were like, oh, this is going to take us into recession. So that was material because that can impact corporate earnings. Right. That's the whole game. If corporate earnings start to fall, you've got a lower numbers and equity prices are so high. So the volatility came through that. Middle East, not as much. The Ukraine Russia incident, it shot oil prices higher and it shot wheat prices. That's wheat and oil prices both shooting up. And I know nobody wants to look at wheat and oil prices, but if you could see it, you could see how the Russian invasion really impacted that. And then a lot of people went into recession in 2022. That didn't happen, and stocks and everything rebounded. So Godzilla tariffs were material enough to make the spreads. And let's remember that the mortgage spreads got worse by 20 to 25 basis points. So it's nothing like what we saw in 2023. So the spreads are naturally getting better, which typically is the case at this point of the economic cycle, working from an elevated level. But it has to be something to really impact the domestic economy to get the stock market to act up really wild and possibly get the spreads to be worse. But the spreads are doing its thing, which is, I stress to everybody, mortgage rates would be like 7.75 today if the spreads didn't improve. So it is a positive that that's happening. And our job is to teach how mortgage spreads work and how it's going, because I could clearly see this is not a topic that not a lot of people in real estate and mortgage, God knows consumers don't know and don't care. But this is something that we've incorporated into the tracker every single weekend so people could get a visual. But again, it's always, I don't care about the answer. I care about the why, right? As soon as when people understand the why, then the answer makes more sense. But I think that's more important when you talk about economics.
Totally agree. Logan, thank you so much for being on, giving us the why in this award-winning podcast, as you said.
Yes, thank you very much, Sarah Wheeler. And make sure to put that award-winning certificate somewhere nice.
Absolutely, I will. All right, we'll talk to you again soon. Thanks, Logan.